everybody. Welcome to Friday, another Talk Money with Tom show. We're coming live from Silicon Valley today. Love to be able to answer your questions. This show is about trying to help people improve their retirement. And we do that through answering questions. You can send those questions in now. Ask Tom at talkmoneywithtom.com, or you can even put them into the chat here on the channel, and we'll try to answer those live. You can send those questions in during the week, and so we've got some good questions that came in this week, and we cover questions that came up from clients in their strategy sessions or other conversations also. We believe education is a big component of trying to have a more successful retirement, and so we created this channel so that we can kind of create content that you can watch and learn from. And I think we have over 1,200 different videos on here now, and so you can subscribe. You can hit the little bell button if you'd like to, get notified when we put something new on. And of course, if you want to, you can meet with us and spend 30 minutes with Eason and I on the phone, face-to-face, video, whatever suits you as far as that goes. And we can answer some of your questions directly. So really looking forward to today's show. I want to thank everybody for joining us. And again, send in some questions. We'd love to be able to answer some of those here live on the show. And I always do start off the week, the show really with a summary of what I saw happening this week in the stock market. Really fascinating week. So let me cut to that here. All right. So we've had this chart going for quite a while, since the beginning of last year. I've added a new trend line. And so the first trend line there that's going down was mostly last year, kind of connecting those tops. Yep. And so a traditional down market analysis, the primary move, one of those pieces is lower highs. Yeah, so we had that last year. You can see it touched that trend line roughly 4 times. Well, this year we're now looking at an uptrend, and again, one of the classic components of an uptrend is higher lows, right? And so I've driven that, and I'll go ahead and get rid of this other trend line for the moment, and we might not see that come back again. We'll focus on this new one. And so what's happening this week is actually really critical, because you can see we're right at this trend line. We hit this trend line on Tuesday, and we've had some gains. Today we're up quite a bit. Yeah. We were up around 1.5%, when the show started here, and a whole bunch of things are happening here. And back in July, we started talking about the fact that the market was going to need some type of consolidation period. And that we were going to, we'd stretch too far, too fast. And there's a lot of different ways of looking at that. But there's no doubt in my mind that was the biggest problem. And this week, even in the weekly videos, I was talking about how, like the news doesn't always line up with the markets, because they're basically trying to attach news to the market move. So, for example, we found out over the weekend that the government was going to stay open for another 45 days. Should have been up. Market actually went down in the morning on Monday. Yep. Ended up flat in the end. And then we had, the Speaker of the House vacated for the first time in American history on Wednesday. Should have been down maybe, because now that kind of creates problems for the continuing operation of the government, past that 45-day period. Market was up. And so the real reason is because we stretched too far, and we had to kind of refill and come back down to these support levels. And there's a lot of different support levels that we're hitting. So we hit those on Tuesday. Market's up on Wednesday, even though that's when the speaker situation was happening and such. And here we go. We're going. So a lot of times, we want to attach different news events. It is about the supply and demand, the support levels, the different, trend lines, what's the primary move. These are more important things to kind of understand, at least in my opinion. Again, this is an educational show trying to help people understand, how to invest, or even how to understand it. If you have, one of my main things is, if you have an advisor, the more you understand the market, the easier it's going to be for you to converse with that advisor, to stay in the market when things go down, to kind of understand. Because, for example, if we look at this downturn that we've had since the end of July, a lot of people get concerned, because the market's going down, when's it going to stop, and those types of things. Personally, I don't get concerned until you start to break through some of these barriers that I know are there. But so that helps me. It gives me some comfort as far as that goes. So we have this trend line was one. We've been talking about this 200-day moving average, which often can create support itself because it's a very, very popular moving average that is well known. We didn't quite get all the way to it, but it's there. And then, of course, we've talked about last time was kind of just this overall support level at a certain price, in this case around 4,200, really between 4,050. That's why I have two lines there, and 4,200. And again, we didn't quite get to it, and maybe we will, right? Maybe that's the little bounce that we're having right now is just a little bounce, and we'll continue down, and it's still yet to be seen what's going to happen here. But if you kind of put them all together, and it gets kind of messy, there's all three of those things there, and it's no wonder we're having a positive week and a really positive day. Right?
And also, it was extremely oversold.
Oh, yeah.
And like, it's like when you start to see the fear index at extreme fear, a lot of people go in as a buy signal.
Yep, that's exactly right. And I follow a measure called RSI, and RSI is kind of a stretch measure. That's what I call it. And so when RSI gets below 30, that means it's stretched really far down to the downside. We hit that a couple times this week and came back, right after that and kind of bouncing off of that. And so what they call oversold just means that basically the market's moved too far to the downside too quickly, and really also probably means that a lot of the people that we're going to sell are already done, and it leaves the minority, maybe the buyers coming in that can now be the majority and move the market as far as that goes. And again, just to reiterate, the kind of the way these rebounds work, at least here in the recent past, has been we get down to some support level, and we got three of them here all at once.
Yep.
We get a bounce, and then all of a sudden the people that are shorting the market panic, right? Because when you short the market, you borrow the stock from usually a brokerage, and you go ahead and you sell it. So if I want to short Apple, I borrow Apple, I sell in the open market. Let's just say simple numbers, $100 a share, right? I'm hoping it goes to $80 a share. I could buy it back and give it back, right? I make $20 a share. Perfect. However, it could go to 120, 200, 300, 400. There's an unlimited risk to shorting the market. And you can cover those with different options. There's all kinds of different things that happen. But generally speaking, you can get a panic buying scenario when there's a lot of short interest in the market. And there is a lot of short interest in this market because people are still believing that this thing's going to fall apart. They might be right. This is the same group that's been wrong all, since last October.
Yep.
Really, October 13th was the low. Today is the 9th. Is that right? So we're almost exactly a year away from that low point. And still reading about people believing the big recessions, here, the same people that were talking about it for the whole year. So far that hasn't been accurate. And the market is still in a primary uptrend. There's nothing here that violates that primary uptrend. And until that happens, you just kind of can relax a little bit and say, okay, let's just assume this is going to continue, right? And I have got my checklist for when it stops, and then I deal with that. But in these minor moves can be really irritating because you're pretty excited about the value of your statement at the end of July.
Yep.
Not so excited about the value of the statement on August and end of September because we've had a couple of down months. One other thing I found here, this is very fascinating. If you go back to the top and you count the number of days between tops, so you go back to the beginning of 2022 and you count top, all the way through to now, to the top that happened at the end of July, the average length of time between tops has been 4 months, approximately. And so think about it. If it's 4 months from top to top, that means it's 2 months to get to the bottom and 2 months to come back. Again, very simplified, but nonetheless, it has been almost exactly 2 months since from October 3rd to the 31st of July, which was the top here. So that's another piece here. This what they call a cycle. So we're also hitting the bottom of the cycle, right in the middle, right when we should be hitting the bottom. And if that cycle happens to hold, then we would be at a new high at the end of November, right? I mean, so there's a lot of things that are there that if you look at the supply and demand for the market and you look at these things as more the minor motion in an overall primary upward motion, then you can feel a little bit better about those statements. I've said this before, in order to get to a new high this year, or even to get to the new all-time high that we've got there at the beginning of 2022, sometimes you have to come down to get to a point where people see it as a bargain.
Mm-hmm.
They come in, they start buying, short sellers start covering. We get this motion upward quite nicely. Everybody starts to get fear of missing out, and individual investors start jumping in, and all of a sudden you end up with a new high. Right? That's how it works. Now, doesn't always work that way, but there isn't a lot going on right here when we talk about this economy that scares me that much, because today's jobs report was pretty phenomenal.
Yeah, jobs created 336,000 jobs for the month of August, and but it's kind of weird because they also revised or month of September, and they revised August and July for another 119,000 jobs.
Wow.
And so when you first initially look at the report, oh, is this too hot? Is the thought process.
Yep.
But we saw wage growth only come in at 0.2,
Yep.
and like the annualized wage growth for the last 12 months is only 4.2, which is lower than the previous month.
Yeah, exactly. So the market dropped right away in the morning, almost 1%. And because the jobs report was so high, it was supposed to be 170,000 new jobs. It was 336,000, almost doubled.
Mm-hmm.
And but then when you looked at it, you realized a couple things, in my opinion. Number one, it was mostly in the areas where we have the biggest problem with jobs right now, which is kind of the leisure, entertainment, hospitality. And it's a little bit seasonal too, honestly. So some of that stuff's probably because of the summer and the time of the year. But nonetheless, the wage growth was only 0.2% for the month. Mm-hmm. If that happens to continue for the next 12 months, that's 2.4% wage growth, which was well below average.
Yeah.
And so they're able to create a whole bunch of new jobs without having to increase wages dramatically. And what that does is it gives some room for less inflation, because if you're a restaurant and you're packed constantly and you have lines out the door and such because you can't get enough people to work in that restaurant, you can start to charge higher prices because you can.
Yep.
If you can get more people in, you can serve more. You probably make more revenue in total. But if you can't get them in, then you're going to raise your prices. And so really a high number of job growth in an area where we're having inflation and especially when the main restriction is labor, right? Which is the service side of our economy is where we're struggling. There's more, labor needed, right? So if we create more jobs, that helps with that inflationary situation. And I've been saying that every time we had this. Last time we had a big blowout like this was in January, and we ended up with a big run in the end, right? But that day it was down. And I remember thinking it doesn't make sense.
And decent amount. There's also a lot of government hiring in September, and a lot of that came from state education, so teachers.
Yep.
That's right. Start of the school year, a lot of people start getting their first paychecks or start actually joining the schools at that point.
Yep.
So it's kind of like and usually in September, November is when a lot of graduates start their first jobs too.
Yep. Yeah, that's right. That's right. So the number of job openings grew this week, and so that was seen as inflationary. But we have a very healthy economy. The problem could be that it's too healthy. So now the Federal Reserve is going to be meeting November 1st. They're going to be looking at this jobs report. I think it's kind of a mixed picture for them. Number one, it's a lot of new jobs. It seems like a tight labor market, but there was not much in the way of wage growth.
Yeah, right? You can nitpick for either side. Right. You could argue either side for them.
And the market right now is still predicting more than 60%, I think it was 68% probability that we will end up with no rate increase.
I think it's up to 73 right now.
So it got back up to 73, okay. Yeah. But it was at like 81 a week ago or what have you. Yeah. But still very high probability, at least from the market standpoint, that we do not have a rate increase in November, although when I looked this morning, it was getting closer to 50-50 kind of on the December decision as to whether we would have a rate increase. Again, closer than it was before because of the job growth.
Yeah.
But again, once you digest that whole report, I think it'll be interesting to see what the Fed does. They'll continue to come out and say aggressive things and higher for longer. And they'll run out a bunch of Fed governors
Yeah,
who say, hey, we need to do 2, 3 rate increases. And it's funny, actually, one of the things a lot of people don't realize, a lot of the people they're interviewing don't actually have a vote. You know, you can be a Fed governor, and only some of them get to vote. It's a rotational thing. And so, you know, they're interviewing Mary Daly here in San Francisco. She doesn't have a vote. It's just her opinion and kind of what she's seeing and what have you, you know. So that type of thing happens fairly often. But again, you know, they're worried about a very hot stock market. Getting to a new all-time high is something I would love, but the Fed would not be as excited.
yeah, and it's also there's going to be some sort of deflation because a lot of student loans have started again. So October is the first month where there's actually starting to have payments,
Yeah.
and so that takes some money out of people's budgets.
Yeah, exactly. Exactly. So it's, anyway, a pretty good week, still a good market. I'm still really impressed with this overall run up that we've had for the last 12 months. And, you know, the whole kind of climbing a wall of fear is a saying you hear all the time from, you know, from the stock market and Wall Street. And that's exactly what this market's been doing for the past 12 months, just climbing this wall of fear. And it's really because when you really boil everything down, earnings are still really pretty good. You know, maybe they aren't as great as they were at certain periods of time, but they're really very solid altogether. And these companies that are reporting they're companies we know, and they're big, and they're on the S&P 500 or what have you, because they're really good at managing their earnings. And they continue to do that. American companies continue to lead. If you look at the overall indexes, you know, like the Vanguard Total Stock Market Index or the Vanguard Total International Index, for example, the Total Stock Market Index here, which represents American stocks, continues to do well. So it's a good place to invest. It's still a good time to be out there investing, in my opinion. And, you know, we'll see if that changes. You know, we break through some of these barriers, and we'll be talking in a different manner. But I always try to make sure that people understand what primary direction we are in at any point in time. And we are in a primary up market right now. That hasn't changed. Really, you know, since the beginning of this year was when it really became more obvious what was happening, when we started setting higher highs instead of lower highs. That was a big one, right? So anyway, that's what's happening. I want to thank you very much for, you know, listening to the summary, and I look forward to talking about it again next week. All right, let's start off with some of our questions.
So this came in from a viewer. What do you plan on replacing short-term T-bills when the Fed finally begins to lower her interest rates?
Yeah, this is a really good question. So this is reflective of some of the other comments I've made on daily videos, and even I think last week, a weekly show, was that, you know, actually let's review our signals too, which I forgot to do, but our signals are both red for the stock market, right? And both red for the bond market. And so we have different programs that we use. So being both red on the stock market doesn't change a lot for us right now, because we are in a primary upward stock market motion based on a whole bunch of measures we use, but primarily 50-day moving average is above the 200-day moving average. You know, simple. And so we use a rotational thing where whatever's, you know, working stays in there, and if it falls below a certain level on our list, then we get rid of it and move it. Now, when you're in a down market, when the 50 days below the 200-day moving average, that's what's happening for the bond market right now. So we have a different program. We ratchet all holdings to whatever's at the top of the list, which right now has been T-bills, right? Because the bond market is getting hit pretty hard right now. We're getting some really big motion. It's kind of interesting to watch because some of it doesn't make sense, but nonetheless, it's happening. So we've been out in T-bills for quite a while, and we avoided this whole downturn. You know, not making a ton of money, but T-bills are paying a lot more than they used to. So it's, you know, not terrible. So what the question is okay, when the Federal Reserve starts lowering rates, what are you going to get back into? Okay, number one, understand that the market will move way before the Federal Reserve starts lowering rates. And so I did make a visual for this just to kind of make sure everybody kind of understands this. So here, going back to like 2004, the last two times the Federal Reserve started lowering rates, the 2008 downturn, right? And then really the early part of 2019. And so if you look at those two time frames and you look at the actual bond market, and what I'm using here is to represent the bond market is an ETF called the iShares, U.S. Aggregate Bond.
Yep.
It is very inclusive. There's 4,000 bonds in there, maybe more actually. And what I did is I put those blue arrows in for when the Fed actually lowered rates. And I put some little circles there for when the market kind of took off. And both those circles are 9 to 12 months in advance of the rate decrease. So you got one thing to understand, of course, the market is a predictor of what's going to happen, right? There is a lot of money in the market. There is a lot of intelligent people trying to make money in the market and with lots of resources, and they are ahead of the Federal Reserve. They really are. And so what you really want to watch is not so much the Federal Reserve and when they start lowering rates. You just want to watch the overall bond market and wait for that motion. I will point out some interesting things in this chart. So going back to 2004, you can see the bond market was going up, and you don't even really need the bond market to go up to make money, because if it's paying you 5 or 6%, dividend interest, and it just goes sideways, you make your 5 or 6%. That's not terrible. And you can see, right before that second bubble there was quite a period of time there it went kind of sideways. But then we had this massive run up because of the pandemic. They lowered rates. The Fed started purchasing, bonds. And then we had inflation, and you can see then it fell. And we ended up with one of the worst bond markets in history during that fall. Got a bounce. And we're just really coming back down. Where we are right now is where we were from, what is that, 2016, 17, 18. We were in the same level that we are now as far as that goes. And so I think there's going to be some opportunity in the bond market. And so need to wait until it kind of falls apart a little bit more if it needs to and starts to come back up before we get interested. But we have our signals. So what happens when we get a green signal on our fast? When we get a green signal on our fast, we're going to go back in with our IRAs and those types of things where we don't have to worry about taxes. So we try to slow down the transactions in our non-IRAs. When we get a green signal in our slow, we will go in and make the adjustments to our taxable accounts at that point in time. And so what we do, and just to kind of show this, is we have this model. So we have 10 of them, right? 10%, 20%, 30%, all the way up to 100%. We have different types of model. We have green, we have ESG, we have traditional, we have a lot of models. But what I'm going to show you here, the green part of this particular model is the bond portion, right? So it says core, core, core. So 60% of this 90% exposure to bonds and money market is going to go into core ETFs, okay? So core ETFs are very broad, like what we just showed you. The iShares US Aggregate, the Vanguard Total Bond Market Index, those types of things. We have 68 ETFs on our bond list, kind of our bench, right? And 25 of those are core ETFs. They qualify as core ETFs in our opinion. Those 25, 3 of them are competing to get into that spot all the time. And so when we get a green light, we're going to look at the top of that core list, and we're going to take the top 3, and we're going to put them in there. Now, we also have targets. Now, targets are subsets of the core. So they can be treasury, they can be corporate, they can be short, medium, long term, they can be treasury inflation protection securities like TIPS, they can be high yield, they can be international bonds.
It could be muni or something like that.
Yeah, muni, you name it, anything that works. And what we're doing there, again, there's 43 of the targets, right? 25 core, 43 target. And in that, we've got 3 positions. So 43 players are trying to get on the field, and there's only 3 openings. That's how we treat the money management here. And so, we're pretty ruthless. We're not, going to fall in love with one, thing, one player or one ETF. We're going to rotate them to try to get the best rate of return. Our objective, we charge a fee. We want to try to at least make up that fee versus what somebody could do if they just plumped the money into some Vanguard funds, and let it sit there. If we can do that, then all the other things we do are, we don't charge anything else for all our appointments and our planning and those types of things. So we can make up the difference with our asset management. And we work really, really hard at that. And then the rest of it is free. It's a good solution, a win-win scenario. Not easy to do, but that's why we're so ruthless. And just to give you another example, I mean, here is a 50-50 portfolio. Again, I'm kind of ignoring the blue side. That's the stock side. The question was about the bonds. And so there are, again, 3 core pieces. In this case, there's only 2 targets. The targets kind of fade out. And what we have here, again, is that kind of competition. So to answer the question, what we're going to buy, when we get a green signal in our, piece, we're going to go to our list and we're going to make changes to whatever's at the top of our list in the core area and whatever's at the top of the list of our target area. And we'll move out of those T-bills and move back into those. And as long as the 50-day moving average is under the 200-day moving average, we'll go right back into the T-bills again if we get another, red or what have you. So, we try to be very cautious. We don't want to participate in these big downturns. Sometimes we miss out a little bit on the upturn, when we get back in because we need to see some proof. But we're dealing with people that are retired for the most part or, looking forward to retirement. And so we're trying to protect some of that principle. I think that's important too. And so.
And there's likelihood it'd probably be a longer duration, something in the long-term duration if Fed rates start to fall.
Yeah, that's exactly right. I mean, even if the hint of Fed rates start to come, because, we looked at last week the Fed dot plot. Right?
Yeah.
And the dot plot is the Fed's projection for where interest rates will be. And the dot plot is showing lower, at least the Fed's belief, that they will be lowering rates in 2024. Most likely in the third or fourth quarter, in my opinion, would be my guess. And if we look back to the, when the market started to move, it was 12 to 9 months before. We're getting into a range where this bond market could start to move. And Easton's exactly right. When things move, they move more exponentially the longer the term of the bond.
Yeah.
So a treasury can move, but it's only a 90-day instrument. It doesn't move much because in 90 days they're going to come due. You're going to get your money back.
Yeah.
A 30-year bond is going to move dramatically because it's a really long time before you're going to get your money back. So you can actually make money on that, and we did in 2020 when the market was falling. We used some of our stock market money to buy extended duration treasuries because they were doing so well. They were up a lot in 2020 just because, again, rates were coming down. They were lowering rates, right, during that period to support the economy, against this pandemic as far as that goes. So very, very good question. Really kind of interesting altogether. All right. What else do we have?
How is Social Security benefits taxed? It's a bit of a weird process.
Yeah. So Social Security used to be tax-free. It just came. And then I think sort of as a means test in a way, they put a taxation on it so that if you're making, money, maybe you don't need Social Security as much.
Yeah. The idea was to extend the program's life.
Yes, exactly. Because the money from taxation theoretically comes back around into the Social Security department. I'm not sure how that exactly works, but nonetheless, but one weird thing is that they haven't adjusted for inflation the levels. And I was doing seminars back, about Social Security and such back in the early 90s, and it was the same exact numbers. So I do have those to share. And so, here's the table. If you're married, you file joint. If you have 30, and there's what's provisional income. We'll talk about how to calculate that in a minute. If your provisional income is less than $32,000, you still get Social Security tax-free. $25,000 for other taxpayers. If you get 32 to 44, essentially, you get 50% is taxable. Above 44, it's 85% taxable. And above 34 for other taxpayers. A couple things here that I think are important. 15% is still tax-free.
Yeah.
That's still pretty cool. There aren't any pension systems out there that I know of where you can get 15% of the income tax-free. Well, actually, I do have some people getting some military pensions for, I guess it's not even really a pension. It's a like Agent Orange exposure and what have you
Oh, the
for
disability
disability payments that
Disability,
are
I
tax.
think, is one of
Yeah,
the few incomes that
yeah,
are tax free, but that's you have to go through hardship for that.
that's right. Yeah, so there. I mean, for not having to go through hardship and not having to be exposed to something crazy, you still get your 15% tax free. I really think Social Security is a really cool program, and it makes a bigger difference than people realize, especially people that aren't retired yet. I
Yeah.
always hear, oh, don't even count it or whatever. But boy, my clients that are retired appreciate it. They like that income coming in. And so this is how you calculate provisional income. It's different. It is, as usual, they have a different way of calculating. They don't
Yeah.
need to, but they do. They take your regular gross income and they adjust it by subtracting out your Social Security
Yep.
first. So if I had, $60,000 and 20,000 was Social Security, I would have adjusted gross income in this case of 40,000.
Yep.
Okay, whatever, making up those numbers. They also add back in tax exempt interest, so muni bond interest.
Yeah, and then also federal or treasury bonds because you
Yep,
pay
that's right.
federal tax on.
Yeah, and so it just closes a loophole where somebody with a lot of money could say, "Well, I'm just going to put it all over here into munis,
Yeah, muni bonds.
and and still get tax free or partially tax free, Social Security." So that's okay. You add that back in. Then you add in half of your Social Security.
Mm-hmm.
So here's the rub, in my opinion. If you look back here, so if you're over $44,000 in Social Security, in provisional income, you're going to have 85% tax. Nowadays, because they haven't adjusted these numbers, we have clients getting, a couple clients getting 60,000
Yeah.
in Social Security. So they're already at 30,000 provisional income without any other income whatsoever.
Yeah.
So they're certainly, going to probably get to that 44,000 pretty fast, right? So anyway, that's how you calculate it. I would say a majority of our clients are in that top bracket, just because the Social Security amount is high that they're getting potentially, but just to live, you're going to have to generate income to pay your bills,
Yeah.
and to try to live on less than 32,000 to make it tax free. I don't have anybody doing that I can think of.
No, it's a super hard thing to do.
Yeah. So anyway, that's how it works. It is people get confused by it, rightfully so. It's a weird provisional income. It's only used to figure out Social Security. It's not super hard to do, but it's just different as usual. But anyway, that's how that works.
So, how do you plan to save for a large expense like a new car in retirement?
Okay, so new car. So now, we put those in the plan as separate units. We ask the clients, roughly how often they want to replace them. Seems like between 7 and 15 years is the
somewhere
range.
in that range.
Yeah,
10's kind of a common sweet spot.
10's a lot. So let's say it's 10 years. Then we ask the client, what kind of car they would want to buy and how much they expect to spend, after they've traded in their other car. What's the net outflow to get this new car? And so let's say it's 10 years. And the question is basically, should we be saving for that, and where should we be saving for that?
Yeah.
Right? Yeah, I think it's a great idea. And I do have a lot of clients that do that. They're really good about, our clients have money because they're really good with their money. They just are. And so they start to think about, okay, I need 50 or 60,000 or, whatever it is, in 10 years, that's X amount per month. And they start to put that away and kind of save that up.
Yeah, you rather not take it from a retirement account like a IRA or a 401k because it's going to be a massive income hit. And
Yeah.
it's going to be a very big taxable event depending on the size of the need.
Yeah, especially, taking it all out at once to buy that car. Spreading it out at least would help some in terms of keeping you down in a lower tax bracket. But most of the times I have clients that, they have their overall income coming in and they're parsing off some of that. Instead of spending it, they're just saving for that next car, because they know they're going to need it and what have you and that kind of thing. So, where you put it, well, you can put it in the bank, right? And you can put it in CDs and those types of things. And that's becoming a much more viable option.
Yeah, you can get 5% for a CD.
Yeah, you're getting 5% now. Now, you are talking about 10 years. If you look at the dot plot for the Federal Reserve, they're actually expecting the Fed funds rate to come down from 5.5. I think 2026 they had it down into like the 2.5, 3%
Yeah.
range. So if you're going to do CDs, you might not be making 5 over
The entire
that
lifetime.
time of that 10 years. Now, and I'll share this with you because we talked about this a little bit last week, but this is kind of a cool chart. This just shows the stock market rates of return. So the kind of the extremes, the best 1 year, and this is over the last 30 years, right?
Yeah.
So it doesn't go back forever, but 30 years is not bad. Best and worst 1 year, 2 years, 5 years, 7 years. You get down to that 10-year range or even the 5-year range. I think 5 years is kind of a sweet spot. And I've always kind of said that if you're going to invest in the stock market, 5 years is a pretty good outlook. Mainly because the worst 5-year period is a lot less than the best 5-year period, right? And so that to me makes some sense. So maybe as an option, you could take the money that you were saving towards your car for a 10-year period and start to put that into something like the S&P 500, ETF. Yeah. Vanguard has a really nice one, ticker symbol's VOO, for example. And you would just put in your monthly money into that. You can probably set it up automated so it comes out of your checking accounts. Yeah. And so 200, 300, whatever it is a month is going into that. And because over a longer period of time, you should make more money than the banks. No guarantees.
Yeah.
I mean, there's a 10-year period out there that happened once where it didn't make money, so it doesn't always work. But I'd certainly consider it, and especially because you're dollar cost averaging. Very powerful concept. When you're putting money in every month and the market drops, that's not terrible because then when it comes back, you made money on that, as far as that goes. I probably ratchet that back on the risk as I got closer to my end of my 10-year period. I get into that 7th or 8th year, I might start taking some off the table.
Yeah, you probably want to move most of that into cash at a certain point where.
Yep. Yeah, you don't want right before you're supposed to buy your car, a big market crash to take out a bunch of your money for the car savings. Yeah.
And then you have to buy a cheaper car.
Yeah. So anyway, it is a good idea for these major expenses that you're going to have to start to, put money aside. A lot of my clients do that. I think it's really, really smart. They don't like to borrow money and they want to pay cash. And so, they've got that set up by the time it gets there. I don't think it's a terrible idea to have kind of a stock type savings account for that where you're just kind of plunking money in. The stock market averages roughly 11% a year, over the long term. So, try to capture some of that with your savings. And it just means if it works, if you needed 60,000, maybe you only have to put in 50,000 because the other 10 came from growth and help make the market help you pay for your car. Got to do it right, got to do it intelligently, probably need to liquidate some of it before the end of the 10-year period just to protect that principal. But it's worth something to look at, in my opinion.
So with the 30-year Treasury yield rising to or touching 5%, is it worthwhile to kind of buy at 5% and lock in for the long term?
Okay, yeah, 30-year today. I have a chart. We have charts for everything. So this comes from CNBC just today. You can see right above me that little gray box there. The high today was just a little bit over 5%, right? At current when we took this shot was 4.9, and so but what I am showing here is kind of the history going back to 1988 of the yield on a 30-year Treasury, and so a couple things strike me. First of all, 5% isn't that high, right? In the overall scheme of where it's been, as far as that goes, it's a lot higher than it was, right? You look at 2020, it was down there probably around 1%. That was a pretty good deal for the U.S. government right there. They probably issued a lot of 30-year bonds at 1%. Yeah. And so a couple things strike me. Number one, the Federal Reserve expects rates to come down, right? So you could make an argument that locking in at 5 makes some sense, but you're also talking about 30 years. And that's a lot different. So if I'm looking at a 1-year CD or 2-year CD, yeah, good, lock it in, that's fine. If rates go higher, okay, that's fine too. But what I'm looking at here, if I'm going to lock in for that long distance, I need something that's kind of above average. When I
Yeah.
look at where it is right now versus that chart, it's really kind of average, right?
Hmm.
If I'm going to take the, because what can happen, the price of that bond will change. If interest rates go down, you could make money.
Yeah.
And if that's what you're trying to do, I could get into that because I do feel like there's a possibility of some lower interest rates here at some point in the nearest future. If I bought at 5 and the 30-year treasury starts to pay 4 or 3.5, I probably made some money on that
Yeah.
bond and I might sell it just for appreciation purposes. So, but that's a totally different concept. If I'm going to buy and hold it, I want it to be above average. And the reason is because if interest rates go higher, my bond value is going to go down. And if I happen to need that before the end of the 30 years, I'm going to have less money. If I wait and I get an 8%, or this thing went all the way almost to 10% way back,
Yeah.
in time, I would back up the truck for 8 to 10%.
Yeah,
on a
because
30
when
year.
you're investing with a treasury, it's considered risk free.
Yeah. Yeah, it's the U.S. government has, at least in our lifetimes, and so far in its history, had the ability to print
Pay.
new money
Yeah.
and pay for its bills, and borrow money with treasuries and what have you. And as long as that continues, that makes that bond, quote unquote, risk free. You have to be a little careful because it can fluctuate in value, right? It doesn't mean that you don't have, and a 30 year is going to fluctuate significantly more. Matter of fact, the 30-year fluctuates about as much as the S&P 500. It's roughly the same standard deviation, over time. And so it's, you're basically buying the stock market and trying to hold on to that and getting a dividend of, 5%. That 5% is not enough for me to take that kind of risk and try to hang on to that for 30 years. You get 8%, you get 10%. If the stock market is averaging 11, and I can get 10 on a 30-year treasury, wow.
Yeah.
I'm going to take that, right? Because that's guaranteed from a very safe source. Let's put it that way, as far as that goes. So anyway, that's a good question. I like it.
How do I estimate my life expectancy? When I'm doing financial planning, what numbers should I be using?
Yeah, it's a really good question, because it makes a really big difference. Think about kind of what transpires inside of a financial plan. So if I say I'm going to live to age 90, I'm going to run that plan and see how much money I can spend.
Hmm.
And maybe I won't spend as much as it says. If it says I can spend more, just because it makes me uncomfortable, but I could spend more. If I run that plan to age 100, it's going to say I should be spending less than if I was running that plan to age 90.
Yeah.
It just is. And so whatever age you pick, so if I tend to use age 100 a lot. And mainly because I really like to build buffer into the plan and make sure that, in case there's big market crashes or different things that happen, or big medical expenses or things along those lines. But running 100 versus 90, okay, it means that client might feel like they can spend less than they could if I ran it at 90, if that makes sense.
Yeah, you give up, when you have to spend less, you give up a standard of living in a sense.
Yeah. Now, my personal experience has been that my clients don't give up standard of living. Most of the times, whatever standard of living they have, it kind of just maintains and it keeps on going, even if it means spending more money than they should, or if it means spending less money than they should. They keep going down that path. It's kind of incredible. It's very hard to deviate from that. But overall, it's difficult because we don't know. We can go look at the tables,
Yeah.
right? And look at, okay, and one of the things about the tables to understand is you have to kind of look at them from your current age. If you look at the entire U.S. population, for example, I've forgotten what a male and a female is right now, but it's in the 70s, 74, 76. But that includes infant mortality and all these things. So if you're already 70, that's a different table, essentially. So you might be looking at, 85, 95 range, someplace in there, right?
Yeah.
And so you can use those as far as that goes, and that's certainly not a bad place. The problem is that if you're going to use this and try to spend your money down, I've never seen anybody do this, so maybe it's a theoretical conversation. But if you're going to spend your money down to a certain age, the risk is, what if you live longer than that age?
Yeah.
You know, I remember this article I read. I thought it was really fascinating. It was in France. There was a lady who had a rent control apartment in Paris. It was a very nice apartment. The rent control somehow could transfer to the new owner in a certain manner. And so this gentleman approaches this lady. She's 90 years old, right?
Yep.
And says, "Look, I would like to have your apartment when you pass away, and I'm willing to pay you every month money." I don't remember the dollar amount, but and she said, okay. And the guy probably felt like it was a good bet because she was 90 already, you
Yep.
know. She turned out to be one of the older living people on the planet. She lived to 120 years old, and lived longer than the gentleman who had wanted the apartment. But the contract, the way it was set up, his estate had to continue paying. And so my point is, sometimes people, you just live longer than you think. And actually, in the world of financial planning, it's one of the harder things to deal with.
Yeah, it's one of those big risks, longevity risk.
Longevity risk is a I mean, if somebody passes away early, it's not a good thing for them, for their family, for anybody. But financially, it's easier on the money. You know,
Yep.
just not as much time that the money has to support that person, versus somebody who lives longer. Those are the ones, and I deal with those clients, and I have those conversations, and people say, "I didn't think I'd live this long," and they took Social Security early or whatever it might
Yep.
be, and so to me, longevity risk it's a real thing. I see it on a daily basis, and it would be something that I would be trying to prepare for, and I do try to prepare my clients for all the time. Is that because again, there's lots of risks in retirement, but that's one of them that can be kind of disastrous because what age you picked in your plan, you spend towards that level, and then all of a sudden you live past that age, you could have some issues, and maybe your money is not sufficient anymore. Maybe now you're having to sell your house and move somewhere out,
Yeah,
whatever it might be.
it's a balancing act. You
Right.
don't want to plan too far in advance that
No.
you change how you live,
Right.
but you want to still avoid that risk.
Right. All right. Well, that's our show for today. I want to thank everybody so much for coming. Great questions. Please keep sending them in. Send them in this week at asktom@talkmoneywithtom.com. We will answer them on the next show. Give us a chance to put together some information. Really, really interested to try to help you there. And of course, you can subscribe to our channel, go to our channel, watch videos, increase your education. Can't emphasize that enough. This is not information that you're going to get in college or in high school or middle school. It didn't come out of the schools. This is why we put this channel together, and you can hit the bell button for get notified when we put new content on to kind of keep up. And then lastly, of course, you can meet with us. You can go to a book appointment button on our website. Website links right here on the channel. And then you can, just set up a 30-minute time to meet with Ethan and I. So I want to thank everybody so much for watching today's show and look forward to seeing you again next week. Thank you.